Hello, very good morning to all. Welcome to today's daily dose of market insights. I'm Kelvin Wong here again, the senior market analyst of OANDA Asia Pacific. Happy Friday and good morning. Today will be the 15th of March 2024. So before we start our daily dose of market insights, let's take a look at the disclaimer slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Excuse me. All right, so now let's have a quick recap of what has taken shape yesterday overnight, and as well as the key data and event that impact the performance of the broad-based cross asset classes, ranging from the benchmark major stock indices, the FX market, the commodities market, particularly on the gold and West Texas crude oil that have been covering the usual space. Yeah, so yesterday's key data release was more from the perspective of the US, but nevertheless US still impact globally. So that is the release of the PPI data. So PPI data we consider as a factory gate data. That means, i.e., we put it away that inflationary trends for US producer. That means if we see inflationary trend in US producer still rather sticky on the upside, very likely it may trickle down towards the end user, to the consumer inflation. But because businesses, whatever business we call it, getting their raw material costs still remains elevated, it could actually impact their cost of pricing of goods and services, which eventually will filter down to a higher CPI inflationary trend going forward. So if you look at yesterday's data, let me share with you the release of yesterday's CPI data, PPI data, pardon me, US PPI data. Okay, let me expand my screen. Okay, good. Okay, so if you look at this over here, this PPI, so PPI, right, if you look at from a core basis, that means excluding excluding energy and food prices, which tend to be much more volatile. So it actually came in slightly above expectation. Okay, so what you see over here, it's 2% year on year. Market is expecting 1.9% year on year. So if you look at the trend of the core CPI year on year data, it's kind of remains, it's not ticking upwards, but it's not also coming downwards as well. So it seems to be stabilizing at that 2% level after dropping rapidly since the summer months of last year. Okay, so you look at previously 2.8, 2.5, then after that 2.7, then it drastically continued to decelerate. It's only at the start of this year, January, then February, it starts to actually kind of plateau off from prior months of deceleration and starts to remain rather stable at the 2% level. So that actually kind of give a bit of what I call credence to the previous slew of Fed speak. So what is Fed speak? Fed speak. So Fed speak is actually public speeches made by Federal Reserve officials. So they are actually quite mindful to actually cut rates rapidly as being priced in by the market participants at the start of this year. So based on the last few weeks of Federal Reserve official public speeches, they are more inclined towards having a cautionary approach in this what I call Fed dovish pivot narrative that is being highly anticipated by the market. So no change in terms of what the data has come up. It came to me that it's pretty much in line with market is actually pricing in right now based on the Fed Fund futures market. So the Fed Fund futures market is still looking at, for this coming March meeting, that means next week, there will be no change in the Federal Reserve Fed funds rate, still maintaining at that 5.25% level. So you look at the CME FedWatch Tool. For those who actually follow our daily dose of market insights, I'll be using this website to give an indication what is market expecting on the action of the Federal Reserve as being implied by the movement of the Fed funds futures interest rate contract where the CME come out with this FedWatch tool to actually calculate the probability for us. All right, so just Google CME FedWatch tool, you're able to get this same page that what I'm showing on the screen. So you look at the 20th of March. So this is the latest upcoming meeting next week. So almost no change, 99% chance it will stamp at 5.25% and 5.5%. So that is the current Fed fund rates. So in the last, I would say, 3 meetings or so, or 4 meetings or so, it has been stamped at, means the Fed actually neither hike nor cut. But markets are still expecting the Fed to cut. It's only that the expectation is being pushed forward to the June FOMC meeting, 12th of June. So you look at 12th of June FOMC meeting, there are actually 60%, 62.5% taking into account of that 2.5% looking for a 50 basis point cut. You add together 60% looking for a 25 basis point cut to bring the Fed fund rates to 5 to 5.25%. So market is still expecting that Fed pivot, dovish pivot narrative to be still intact for 2024. That means they're still expecting the Fed to cut. So now the big question over here is that after the first cut, the highly anticipated first cut right now in June, what will be the next step the Fed going to do? Right. So if you look at the, you know that interest rate futures, they have it actually trading continuously every month. I mean, there's new contract coming in. So the CME FedWatch Tool also have a combined probability as well. That means they look into other months down the road and have a combined probability. So if you look at this combined probability table, we could have we call it implied indication, a rough estimation gauge of how much more will the Fed potentially cut going forward after the highly anticipated June cut that is being priced by the 60% probability by the Fed Fund Watch tool. So if you go down the road over here, you look at this box over here, then you focus on the green, the light, I'll say the light blue box, and move it diagonally downwards, okay? Because this is the meeting date. So as we stretch all the way down, is going forward the couple of months. So if you look at over here for the March one, 5.25, no change. For the May one as well, 95%, no change probability. Then after that, in the June meeting, you realize that this blue box shift diagonally downwards. All right, so this one cut, 60.3%. Then in the July meeting, horizontal, it didn't shift diagonally downwards. Diagonally downwards, it's white in color, it's not turquoise, it's not in blue. Then thereafter, it shifted down 44% in September. So that's another cut being implied by the market. Then thereafter, no cut as well in the November meeting. It's because it's horizontally down. Then thereafter, in the December meeting, there's 35% chance of another cut diagonally over here. So if you look at it diagonally down, how the blue boxes or light blue boxes take into we call it as is appear. One cut implied, two cut implied, three cut implied. So that's the December meeting, 18th of December. So if you look at the current pricing based on the CME FedWatch tool, is now pricing only 3 interest rate cut before 2024 ends. All right, so that is also more in line with the dot plot. Okay, so what is the dot plot? Like, remind you all again, dot plot is a set of forecasts released by the Federal Reserve officials in not every Federal Reserve FOMC meeting, is every 3 meeting or so, they will release this latest dot plot forecast. So this dot plot forecast will focus on the inflationary trend in US, the economic GDP growth trend in US, and most importantly, the trajectory of the Fed funds rate. So in the last dot plot that was released around 2.5 months ago, that means in December. So last year, the Federal Reserve turned very dovish because they're very confident that inflationary trend has started to decelerate, and they pencil in a median forecast of 3 interest rate cut for this year, 2024. So at that point in time, because the Fed started to turn very dovish, market jumped the gun and start to price in 6 interest rate cut instead at the end of December and at the start of this year. So what we start to see now has started to see new we call it economic data start coming in, and the inflationary trend in US didn't further decelerate, and instead they start to plateau off and stabilize. And the current slew of Fed speak seems to be pointing to a much more cautious approach in their interest rate cut so-called trajectory or projection. Therefore, the market pricing now has started to slowly move in line with what the dot plot is actually implied. So 3 interest rate cut, similar to the dot plot, 3 implied interest rate cut by the Federal Reserve officials median forecast. Okay, so now what's important over here in next week on 20th of March, because it really comes to the 3-month, was every 3 months they will release a dot plot. So this is the third month, the 3 month has already passed from the December meeting. The Federal Reserve official will sit down again and discuss based on the current data, what they have, and they'll release another round of new dot plot projection. So market participants were very focusing on whether will they still maintain that implied 3 interest rate cut that they have earlier in December. So let's say if the market is still in line with market expectation, I don't see there's much big changes in terms of the market movement. But however, if the Federal Reserve starts to reduce to 1 interest rate cut instead, that means from 3 to 2. So that could have a significant impact on the market, especially number one will be the US dollar. We may start to see a bit of US dollar strength coming back. Why? Because of the US 10-year yield Treasury pushing up back again. And also potentially it could also impact the stock market as well, given the fact that cost of funding will remain relatively high instead of coming down. So that could actually impact the rosy performance that's seen so far in the benchmark US stock indices. So something to keep a close eye watch to next week. All right, so that is on the US side of the story. So how does it impact the market? All right, yesterday price movement. So yesterday price movement was actually hit on the dollar side of the story rather than the stock market. So if you look at the stock market over here, it's not that bad. I mean, the market didn't collapse by 1% or so based on the Dow Jones Industrial Average, the S&P, and the Nasdaq. The only one that is hit the worst was the Russell 2000, the small cap, down almost negative 2%, because like I say, Russell 2000 is a small cap company. So this small cap company, majority of them tend to have very weak balance sheet. That means what about weak balance sheet? That means i.e. liabilities more than asset, negative cash flow, and due to this fact that it has a psychological we call it a feedback loop back to the market participants. These companies are actually in need of financing to actually sustain their business operation. So any signs of what I call Fed dovish pivot getting reduced by an increase in the US 10-year Treasury yield, that could negatively impact this Russell 2000 the most. So that's why they actually explained their underperformance yesterday. But if you look at the rest of the other major indices, the SPX, the Nasdaq, and Dow Jones, all of them have kind of muted reaction. Yes, they came down, but they didn't come down as much as the Russell 2000. So the three of them, S&P, Nasdaq, and Dow Jones, only shared on average negative 0.3%. All right, and if you look at the heat map of the S&P 500 stocks, okay, in fact, we start to see a very mixed bag performance in the in the 7 mega cap stocks that's a higher weightage in the S&P 500. So yes, the Nvidia got hit again, negative 3%, but it's being kind of counter reacted with a positive performance by Microsoft, Apple, Google, and Amazon. All right, so it's kind of a not like I say a rampant sell off throughout the board, what you could see over here. So it's rather kind of a mixed bag performance. Then yeah, like I mentioned over here, it impacted the US 10-year Treasury yield. We actually translate to a significant intraday bounce on the dollar. So what we could see at this point in time, the US 10-year Treasury yield over here, where was the yield? Okay, yes. Yeah, this is the Treasury. So the Treasury yield actually managed to recapture back above the 200-day moving average. So yesterday it actually rallied by 10 basis point. So this 10 basis point is the most significant is the biggest intraday jump in terms of basis point, 10 basis point since 2nd of February. So it's almost a month. Almost a month we see this big jump in the we call it intraday significant jump upwards on the US 10-year Treasury yield. So it surpassed the 200-day moving average, but still holding below the 4.33 slash 4.5%. So this is the kind of a major resistance zone that I'm watching for the US 10-year Treasury yield. So if we start to pierce past above 4.5%, then for sure the US dollar strength could start to be more coming back much more substantially, and it could also potentially translate to a weaker equity performance as well. All right, so we are watching these levels. It didn't so far. It didn't surpass this level. So as long as it didn't surpass this 4.33%, 4.55% level, potentially it's more like a kind of a sideways range configuration going forward, at least in the short term. So we're talking about the short, the next intermediate support level to watch for sure will be this low here. All right, at the 4.06%. Okay, this level. So that actually also translate to a intraday, significant intraday bounce on the dollar. So if you look at the dollar index as a representative of dollar performance, okay, so this bounce came out, it stopped, it actually didn't break down the 102.74 near-term support level that has been held since 16th of Jan this year. Tested one time, two time, three time, four time, five time, fifth time, and yesterday it bounced. All right, but still holding below this important near-term resistance at 103.70, which is confluence with the 20-day and the 50-day moving average coming to as a resistance as well. So what we could see over here is that yes, we may see a bit of intraday strength in the dollar, but the dollar hasn't surpassed the dollar index didn't surpass the 103 70 level, 103.70 level, key intermediate resistance or key near-term resistance level that's being confluenced by the 20 and the 50-day moving average, I think as a resistance level as well. So we cannot be very, very confident to say that we now see the start of a substantial dollar strength unless this 103.70 key near-term resistance being taken out on the dollar index. All right, so this is a dollar index. So I'm just using the dollar index as a proxy for dollar strength and dollar weakness. All right, okay, so this is the key intermarket linkage that has kind of impacted the cross asset classes based on a much more rather we call it, I would say that rather less softness that's being seen by the PPI number. Okay, but what's interesting over here, despite the push out in that US 10-year Treasury yield, gold price didn't collapse. So gold price XAU/USD managed to held at a key short-term support level that I've been highlighting since the start of this week in our daily dose, which is at 2153 support level. It managed to stage a retest today and bounce up. Okay, so the thing about gold price over here is that it's being also supported by this geopolitical risk premium that is still positive due to this ongoing, we call it, unfortunately, Middle Eastern conflict that's still playing out in the Red Sea and between Israel and Gaza. Okay, so with that, what other economic data to look out for that has happened, that has taken shape in today's Asia session before we start our daily dose, okay, will be this release of China data. There's some key China data. Housing price index. So housing price index actually continued to plummet in China. So on a year-on-year basis, it's actually down negative 1.4% year-on-year from negative 0.7% year-on-year in January. So if you look at the trend of the China housing price index over here, it's continued to actually decelerate over here. So February fall of negative 1.5% is actually the steepest pace decline since almost 13 months, okay, in the January 2023. So if you look at the 5-year trend, okay, it has been in a kind of a major downtrend movement for the China housing, we call it price index. So still indicating to us that the housing market is very, very soft, and we know that the housing market itself is one of the key, it has a substantial wealth effect on consumers as well as businesses. So for sure, unless we see a turnaround or a stabilization in this ongoing major downtrend in China house prices, that deflationary risk spiral in China is still pretty much real, is still intact. So despite the fact that even though we start to see very strong, like 15% rebound in some of the China equity market or benchmark indices and the Hang Seng indices, in my opinion, that all those bounces are just counter trend rebound. We in a major downtrend phases that are still intact, because fundamentally that deflationary risk spiral hasn't been eradicated in China. And what's important over here is that China top policymakers are not in the hurry to enact a very, very strong form of liquidity fiscal stimulus measures to actually jumpstart the housing market. So if you look at the scenario right now, today's release of the 1-year medium-term loan. This is the 1-year MLF rate. So China, there's a couple of benchmark interest rates. So this is one of the benchmark interest rate that is being potentially something like an interbank market loan, where actually this particular rate at 2.5% is where major commercial bank in China could borrow money from the Chinese central bank PBOC. So PBOC still maintain their rate at 2.5%. So they didn't actually look at the trend. The last cut of this 1-year MLF rate, we call it the medium-term lending facility. So you look at the 1-year trend. Okay, so the last cut was in only August last year. Ever since then, it just maintained steady at 2.5%, despite the fact that the China housing market is still weak. All right, so based on the action of the China top policymaker, they are actually telling us there are actually no rush of enacting massive monetary and massive fiscal stimulus plan. Okay, so that potentially could not actually see a potential major basing formation on that China stock market, as well as the Hang Seng benchmark indices. Okay, so that is the data releases so far for today. So what we have over here is let us take a look at the short-term technical outlook for now. All right, the various cross asset classes. So let's start with the FX market first. So we know the FX market, the dollar actually rebounded yesterday, but still remains on resistance by the dollar index. So what's interesting over here, if you look at the euro dollar, also sell off, but they actually managed to store close. The sell-off actually let us close to the 1.089 short-term pivotal support that I've been highlighting. So this is kind of the former minor swing high of 22nd of February now turns into a pullback support, and as well as this area here, this former rallied last week and now turns into a pullback support as well. And if you look at it over here, I'll be having a little bit of excess at the bottom. Okay, let me expand my screen so that you guys could see. Okay, good. Okay, so I'll be using a bit of excess at the bottom here, 1.0890, slash 1.0870 as my short-term pivotal support for today. So as long as this excess level managed to hold, we're so confident with the upward sloping 20-day moving average as well. We will still maintain that short-term bullish outlook on the euro dollar, and also given the fact that why I still maintain that bullish outlook, because of the current bullish divergence that has seen on the RSI. So you see that the RSI hit into a kind of an extreme oversold territory, okay, very similar to the oversold level that was on 28th of February. Let me share with you. Okay, over here, that led to a mini basing formation on the euro dollar before shaping that recent short-term push up. All right, so it really hit a similar level, and upon hitting this similar relatively extreme oversold level on the hourly RSI, it actually come out with a bullish divergence condition. That means price action on the RSI shape a higher low, whereas the price action of the instrument shape a lower low. So indicating to us that yesterday's downside momentum has started to ease off by the appearance of this bullish divergence at the relatively extreme oversold level seen in the hourly RSI of the euro dollar. So with that, maintain that bullish bias. First resistance, however, today will be slightly lower. So this was yesterday's former minor swing low, turns to a pullback, turns into a near-term pullback resistance level, 1.0910. Then thereafter followed by this all-important minor range stop of 1.097. Only an hourly close below 1.0870 will negate this bullish tone to see the extension of this minor corrective decline to test the 50-day and the 200-day moving average, confluencing at the support level at 1.0845. Below it exposes the next support level at 1.080, which is the minor swing low area of 28th of February to 1st of March. Very similar on the sterling dollar as well. So the sterling dollar managed to actually came close to the this former minor swing high area of 22nd of February to 5th of March, now turns into a pullback support level. We do not see any signs of bullish divergence yet that is being formed on the sterling dollar, but given the fact that the sterling dollar and the euro dollar tends to move hand in hand, so given the positive element that is being seen on the euro dollar, we will still maintain that bullish bias on the sterling dollar due to its kind of a close correlationship in the short term. So using a slightly short-term adjusted short-term pivotal support level today at 1.270. So 1.270 is rather important. Why? Because it's confluenced very closely with two moving average, 50 and the 20-day moving average, both are stooping upwards, and as well as this graphical support area over here, which is the former range stop, now turns into a pullback support at 1.27. So as long as 1.27 figure short-term pivotal support holds, we will still maintain that bullish bias on the sterling dollar. First resistance to watch 1.2820, which is yesterday's minor swing high. So that was yesterday's intraday high. In fact, before that sell-off took shape upon the release of the US PPI data, then above 1.2820 sees the next resistance at 1.2880. Only an hourly close below 127.50 will invalidate this bullish tone to see the extension of this corrective decline to test 1.277, to expose the next near-term support at 1.2670, minor ascending trend line that I drew from the low of 14th of February. Below it sees the risk of 126 figure level. So 126 figure level, minor swing low of 21st of February and 1st of March, and so I confluence with the 200-day moving average. Okay, now Asia Pacific currency, dollar yen. So dollar yen, what we could see over here, it managed to actually came back down again. Very interestingly, it refuses to break above the 50-day moving average that is acting as a resistance. So you look at yesterday, it tried to test, and early this morning, there's an attempt to break out, but after this breakout, there's actually a failure. So if you look at, if I expand it larger on my screen, you guys could see over here that 50-day moving average acting as a resistance. Okay, then today's Asia session, it managed to pierce up, but after that pierce up, it formed a bearish shooting star. Then after that bearish shooting star, it do have a negative price action follow through and starts to reintegrate back into the back below the 50-day moving average. All right, so this indicates to us that this morning pierce up in price action over here is more like a failure pop-up, or we call it a dead cat bounce, or a kind of a bull, we call it a bull trap. Some people look at a bull trap instead. So with this potential bull trap by the price action depicted by the price action on the hourly chart on the dollar yen, we will still maintain that short-term bullish bias on the dollar yen going forward over here, but with a slightly we call it higher short-term pivotal resistance that we have at 14880. So what's 14880 is close, is this region over here, this key graphical resistance level. Okay, broken now. Okay, now turns into a pullback resistance. So 14880. So as long as 14880 short-term pivotal adjusted for short-term pivotal resistance holds on the dollar yen, we will still maintain that short-term bullish bearish bias, pardon me, short-term bearish bias on the dollar yen. With the, okay, let me push my screen here, this dollar yen, so that you guys could see. So first support level to watch will be at 147.95. A break below it exposes 147.25. So that is more for a short-term basis. So these are the two short-term support level to watch if dollar yen can't break above the 14880 level. However, a clearance above 14880 level will actually invalidate this bearish tone to see the squeeze up towards 14950, which is the 20-day moving average, I think, as a resistance as well as this former minor swing low turns into a pullback resistance above 14950, exposes 150.15 level. All right, on the dollar yen. Then what's next for the Aussie dollar? So on the Aussie dollar, it plummeted downwards again, but where it plummeted is now stopped exactly at this confluence of the 50-day, 200-day, and 20-day moving average, all acting as a support level at 165, at 65.60. So given the fact that it actually confluences with three bunches of moving average, 50, 20, and 200-day moving average, potentially we may see a bit of bounce coming back. And if we do the Fibo retracement of the last push up from 5th of March low all the way up to last Friday intraday high, okay, it actually corresponds with the golden ratio as well at 61.8 Fibo retracement, also conferencing at 65.60. So I'll be using 65.60 today as my short-term pivotal support level, potentially looking for a kind of a short-term recovery on the Aussie dollar. First resistance level to watch 66 figure level, then thereafter followed by the all-important last Friday minus swing high area at 65.60. Okay, that prevent further rally from taking shape this week, because every time this week it attempt to come close to the 66.50 level, it can't surpass it and start to trade sideways before plunging down yesterday. Okay, so this level is pretty clear as well, important, at least in the short term. Okay, so as long as 65, 60 short-term pivotal support holds, potentially there could be a minor bounce. First resistance 66 figure level, followed by 66.50. Only an hourly close below 65, 60 will invalidate this short-term potential recovery scenario to see another round of very choppy, messy corrective movement on the downside again. Next support level that to watch will be at 65.20, followed by the swing low area of 28th of February to 5th of March at 64.90. Okay, so that's for the FX market short-term technical outlook. So overall, in the FX market short-term technical outlook, yes, yesterday we may see a bit of short-term dollar strength coming back to play, but based on the various pair that we analyzed earlier on, the major pair analysis, the dollar strength, in fact, yesterday that push up of the dollar strength seems to be at resting at that respective key short-term resistance level. That means translate to some of the pair will be support level in the case of the Aussie dollar. All right, so now let us take a look at the FX market is done, the stock indices. So let us start with the major stock indices, starting from Hong Kong. So if you look at Hong Kong right now, the Hang Seng 33 managed to plummet to below our short-term pivotal support level that we have due to a very weak housing data and the refusal of the China top policymaker to actually cut interest rates. So with that, I will actually turn neutral for today on the Hong Kong 33. Yes, even though it starts to sell off, and the sell off now starts to actually come close to the 20-day moving average, and as well as the lower limit of this ascending channel, this particular short-term ascending channel that I drew from the low of 22nd of January. So neutral for today, no conviction of a recovery. So neutral for today, 16,480 and 16,890 on the Hong Kong 33 index. Then Japan 225 or the Nikkei 225. So this one going to trade sideways. Yesterday during the US session, it tend to sell off, but the sell off didn't break below this low over here. Okay, it didn't break below the low of this Monday, which is at 38,360. 38,360. Okay, so it seems to be that it's still congestion within this short-term pivotal resistance that we have at the start of this week. Also the 20-day moving average acting as a resistance as well at 39,210. So as long as 39,210 short-term pivotal resistance holds on the Nikkei 225 or the Japan 225, we will still maintain that short-term bearish bias on the Japan 225. First support level to watch for today will be yesterday's minor swing low area at 38,360. That didn't manage to actually break down after a retest of it yesterday. So that was so Monday and Tuesday tested 3 times in a row so far this week. So this will be my first support level. Second support level to watch will be at 38,100. Okay, over here. However, an hourly close above 39,210 will invalidate this short-term bearish bias to see a squeeze up to expose the next near-term resistance, the next resistance level at 39,640. Above it, potentially may see a retest of that all-time high area, the current all-time high area at 40,490 / 40,690 level. Then the German 30. So German 30 going to trade sideways yesterday. Okay, it held out relatively firm so far. So didn't break below the first support that we highlight, 17,900. Okay, but we were still using 17,790, slightly lower level that we highlighted this week as a short-term pivotal support level. So as long as this short-term pivotal support level holds, we still maintain that bullish short-term bullish bias on the German 30. First resistance level to watch, thereafter 18,050, 18,100, only hourly close below 17,790, invalidate this short-term bullish tone to see another round of minor corrective decline to retest the minor swing low area of 1st of March to 11th of March, acting as a support at 17,650, also confluencing with the upward sloping 20-day moving average as well. Dow Jones Industrial Average. So Dow Jones Industrial Average, we flipped to a bullish bias yesterday. So if you look at it very closely, the price action retested the 20-day moving average and as well as the pivotal support level that we highlighted and managed to help there since the later part of the US session after that earlier sell-off. So no change, 38,930 / 850, which is the 20-day moving average. 840, pardon me, the 20-day moving average. Still using this level to maintain that bullish bias, but the first resistance to watch for today will be at 39,100. Then thereafter followed by this minor swing high area that is being tested twice, Thursday and Wednesday at 39,270. Okay, so a slightly lower resistance level to watch for today. However, if you see a breakdown below 38,840, then it will invalidate this short-term bullish bias to see another round of messy minor corrective decline movement. Next support level that it may expose 38,660, followed by 38,380, which confluence with the upward sloping 50-day moving average as well. Nasdaq 100 pretty mixed. So Nasdaq 100 yesterday is so off, but managed to help at the lower limit of our so-called neutrality zone that we have for since mid of this week. So we'll be still sticking to that neutrality bias, except that I place it slightly lower today. Okay, so it's a range 17,960, upper limit at 18,335. All right, for the Nasdaq 100. All right, so with that, a rather mixed picture across the board for the major stock indices. So what's next for WTI crude oil? So WTI crude oil going to remains firm. So if you look at the daily chart of the West Texas oil, it's going to actually shape a second day of positive bounce up, positive 1.6%. Okay, increase over here. So the next resistance will be 83.20. So on the shorter term, this is a daily chart, right? On the shorter term, no change. We continue to actually potentially look out for a further push up over here. So there is no signs of what I call divergence. Okay, there's no bearish divergence. Price action going to move in line with the movement of the hourly RSI. So with that, right, we'll be having a tighter key short-term pivotal support for today, given the fact that it already surpassed 80.55 level, the first resistance that we highlighted yesterday. So we have a tighter support level for today, which is this congestion area here. So this is actually the swing low of yesterday's low, yesterday European session low. So this area here will be my tightened short-term pivotal support level to maintain that short-term bullish bias on on West Texas oil, pardon me, on West Texas oil, a bit of tongue twisting because it's Friday. Okay, so this level here will be 79. Okay, 79.70. Okay, 79.70. Then the next support level to watch will be this level here. Okay. Okay, so just to tidy up everything, so given the fact that it already hit 80.55, so we will still maintain that short-term bullish outlook on West Texas oil, given the fact that there's no clear signs of a bullish exhaustion on the RSI. Any potential pullback that's managed to hold at 79.70, we will still maintain that short-term bullish outlook. Next resistance level to watch will be 81.65, followed by 82.80/83.20 level. Then if you see an hourly close below 70 level, then we will see the extension of this minor corrective decline to retest the 200-day and the 20-day moving average, coming to act as a support at 78.40 level. Right, so that's West Texas oil. So this lastly will be the spot gold. So spot gold is where we see this level here is pretty key, tested 3 times so far, 1, 2, 3. So despite yesterday's not so soft PPI US data, the spot gold XAU/USD managed to actually bounce off the 21.53 level. So indeed, this level is a key short-term pivotal support level to maintain the short-term bullish outlook on spot gold. So I do have a shorter-term resistance level to watch for today. We call it R1. Okay, so R1 will be here. Okay, will be yesterday's close to yesterday's session high that can't break and starts to do that sell off after the release of the US PPI data. So that will be 21.82 will be my first resistance level. Above it exposes 2,200/2010. Only an hourly close below 21.53 will invalidate the short-term bullish bias on spot gold for today, XAU/USD, to expose the next near-term support zone at 2125/21. 10 level. All right, so that pretty much sum up for the short-term technical outlook across the board. So let's take a look at the economic calendar before we go. What are the key data to look out for or events to look out for today? So thereafter, in the Asia's in the European, okay, let me make sure that it's okay. Good. Okay, all is there. So throughout today's European session will be pretty much quiet because this data here is the final inflation rate data, so there shouldn't be much of a difference for France because the preliminary data is almost the same. So thereafter, what you have in the US session, pretty much important, will be the consumer sentiment, the preliminary consumer sentiment compiled by University of Michigan. So this is the flash data for the month of March. So market is expecting no change, 76.9 in the previous, similar to previous month, or 76.9 as well. Okay, so one key important data to watch. And also during the Asia session, right, today there will be the release of the Japanese wages. We call it the Rengo. We call it this is particular over here for those who actually, okay, this Rengo. Okay. Okay, so this is the Japanese Trade Union Federation. Okay, so over here, right, there is actually, okay, so this is Rengo. So actually Rengo, this the Japanese largest union group. So they actually demanded an increase of 5.8% average wage growth for Japan employees for this financial year. So they will actually release the findings or the results of their preliminary results of this ongoing Japanese wage negotiation today. But till now, the result is not yet out yet in the market. So if you look at some of the, like Forex Live, is one of the fastest data that related to the Forex Live. Nothing much. So especially the only thing that's come out over here is Japan. Finmin Suzuki said Japan is no longer in deflation. I think that is what is being playing out across the market since 2 months ago. So that shouldn't be a big surprise. So what market is waiting out for in terms of this that could be related to the dollar yen is potentially these results of the wage negotiation results, where market now looking at 5.85%. So any number that is greater than 5.85% could potentially shake the dollar yen movement. That means dollar yen weakness, yen strength. That means coming back into the picture, because that could actually give more resolve for BOJ to actually bring forward their ultra dovish normalization policy this year, and also with the potential expectation that they may scrap short-term negative interest rate as soon as next week. So that is the potential expectation as well. If the wage numbers, the wage growth increase go beyond 5.85%. All right. So we shall see how the result plays out later. So by right, it should be releasing today Asia session, but it's not out yet. Okay. So with that, do have a great weekend ahead, and I wish you all a happy Friday, and we shall speak again next Monday. Thank you.